They're flat, broke. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Walmart just issued a major warning to the entire U.S. economy. I'll show you what the big retailer is concerned about and why, based on the latest data, that it also suggests that the unthinkable has already started. Now, let's go to Bloomberg, where he picked today's story up with the headline, as Walmart sales surge as wealthier shoppers flock to the retailer. And this is not a good sign for the economy, because when wealthy people start to struggle financially and they trade down, it tells you that the economy is now on a path that is unsustainable and that a recession is inevitable. It shows just how weak the economy is, and Walmart's warning that this is not a good sign for the economy. As sales rose 3.8% at Walmart stores open for at least a year for the quarter ending in April, higher than anticipated. But here's the key point. While inflation eased, the average ticket price was flat, but the number of transactions rose just by about the amount of inflation at 3.8% a year ago. So what you're seeing here is exactly the issue with inflation, that consumers are spending less, they're getting less for their money. And even Walmart, who's now attracting wealthier customers who are looking to save money in every way possible, that's not even enough to drive their sales surging higher. And here we can see upper income households that the retailer said drove a bulk of its gains, particularly with e-commerce. And we're seeing customers trade into Walmart. This is actually bad news. And he said of higher income households, who were the largest cohort behind share gains in near every category. So you know the economy is in dangerous shape when wealthy people who would prefer to shop somewhere else are now turning to Walmart to save a few dollars. This tells you that financial conditions are far tighter than the central elites want us to believe, and that we are now on the cusp, maybe even the beginning stages of an all-out U.S. recession. We've historically been thought of for value, but now it's value, quality, and convenience, as Walmart thinks that this is something that they did, but they don't understand it has everything to do with economic fundamentals. People who normally don't shop at Walmart don't want to shop there. They prefer to shop elsewhere. What you're seeing here is household budgets getting stretched to the point where consumers have no choice. And the grocery business has been fueling their growth with general merchandise. Here's a key point. We talk about discretionary spending. That side of sales has lagged, indicating consumers are indeed chasing staples here, not wants, but actually needs. And as higher income consumers trade down or search for deals, Walmart is benefiting from a decision to roll out more discounts and new products in revamped stores. Lower income consumers are buying in similar patterns at Walmart, purchasing more groceries and other necessities in general merchandise. And that is, again, the key point here is we've talked about this trade-off from the discretionary side to, of course, the staples as people run out of money, and Walmart is validating that. But one thing, when people are looking for a good deal, we think, of course, a breakout in Griffin Digital Mining stock is the next one. Here you see the chart setting a low, a higher low, another one. There's the ascending triangle. The breakout just above will show you how that could realize a potential 33% gain when the buyers right underneath it. But earlier this week, Walmart announced plans to shutter small stores, offices, lay off hundreds of employees who are still working from home or can't move to bigger office hubs. So even the labor market now is being impacted by Walmart, who noted that, of course, sales up 3.8% as ticket size as well. They just didn't have the numbers. They are still laying off, and this is an issue. So the question I have for you, are you starting to trade down? Are you getting squeezed by the economy? Because the next thing to go, well, that's the labor market, as U.S. jobless claims now back down after the New York school break ends. But that's only half of the story, because the headline says that, wait a minute, initial claims continue to be at historically low levels. That is not the issue. The risk now is those who are still on unemployment. Let's take a look look here, because when we see Walmart struggling as they attract more customers, which you would think would be a huge benefit, you'll note that the reason we're seeing this happen is everything to do with the labor market, as advanced retail sales shown in blue on a year-over-year rate of change against continued unemployment claims. And even though continued claims remain near historical low levels, the issue is the longer you have people on unemployment, the less spending they do, because they think initially they're going to get a job, and then they find out that perhaps the labor market isn't that strong. And what you see here is as continued claims rise or stay elevated, the natural reaction is retail sales growth slows down. You see that every time. So what Walmart is experiencing here, especially with the trade down effect, is indeed the U.S. economy is slowing at a time when the political elites and the central elites say we're about to experience a soft landing or no landing scenario. Well, it looks like the only thing we're about to experience is an all-out recession. As initial claims decreased by 10,000 to 222,000, this having to do with New York, as of course we see their claims there surged the previous week while public schools were on spring break, and some workers such as bus drivers are allowed to apply for benefits during breaks, which tends to make the weekly data more volatile. But that's not the issue. It has everything to do with continued claims now rising to 1.79 million, suggesting that those on unemployment are unable to find work. And even though the initial claims remain relatively low, people are finding out that when they lose their job, there isn't another one available. And that means, of course, they're cutting their spending, they're trading down. Everything we're seeing at Walmart, we're seeing it happen at McDonald's, is all telling us that the U.S. economy is in a dangerous place. As supply and demand of workers is coming back into better balance, just as we would want, this according to Fed Chair Jerome Powell. And I want you to note that this is exactly what their plan was. Rather than saying, well, we have a lot of demand here, let's increase supply, what they look to do is decrease demand. The risk these central bankers have when they do this, which something happens each and every time, is they throw the economy into a recession by restricting demand so much. We're seeing that now happen at, of course, America's largest retailer. But notably here you see in the article, the 20 years that preceded the COVID-19 pandemic, weekly initial applications were, well, much higher at 345,000, and continuing claims, well, about 1 million higher at 2.9 million. And that isn't the issue that the typical claims rates were higher. The issue is we're coming off of very low levels, and people that were used to having those incomes now no longer do. And they're facing higher prices, they're facing higher insurance costs, they're facing, of course, higher debt service costs, and they don't have the money. If the economy was indeed as strong as everyone claims it is, we wouldn't see the wealthy trading down, and we wouldn't see, well, what Liberty Street Economics just printed out the other day, as delinquency now is increasing in credit cards for maxed out borrowers. And we've talked about how consumers are indeed starting to get to levels where they're maxed out. And yet, what did they do in the first quarter to keep the economy running? Well, they turned to buy now, pay later, which it turns out you can do at Walmart, even with your groceries. The nationwide aggregate credit card utilization rate, that is, well, what the share of aggregate credit limit is being used, was about 23% last quarter, which is on par. But here's the frightening part underneath this. If we look at those using 90% of their available credit, well, that was 18% of borrowers, if you can imagine that have their credit cards absolutely hitting the red line here. And that means their spending power gets taken away. And as we look deeper here, they're going to focus their piece here on those borrowers that they refer to as maxed out and how likely they are to miss their credit card payments. And it makes sense in a big way, because missed credit card payments are caused by many factors they found, ranging from forgetfulness, well, I struggle with that, to cash flow constraints. And here's the big one: income loss. So what happens is people turn first to their credit cards they can buy when they lose their jobs, and then when they run into the red line, they have nothing else, their spending must drop. But even as we've noted, you can go to Walmart and buy your groceries on a 4-pay. You hit the button, buy now, pay later. Well, that's now catching up as these borrowers are facing delinquency. And of course, we know when that happens, the economy is soon to fall. And most of these are difficult to predict or observe. Well, it's not that hard, but one observable factor is strongly correlated with future delinquencies is a high credit card utilization rate. To say the obvious, when people get maxed out, well, it means they're at the end of the line. And here we can see, of course, the maxed out borrowers see increasing delinquencies as a percentage of balances transitioning that way. That meaning this dark blue line, the 90 to percent 100, when you get there, well, you're at the end of the line, and now we're seeing that trend. Now, it's not something we see during a soft landing or no landing. That's something we see when we're headed into an all-out financial crisis as consumers just run out of money to pay on their debt. This is a dangerous situation. And of course, Liberty Street concludes that they've shown that new credit card delinquencies are disproportionately to maxed out borrowers. No surprise. And the share of maxed out borrowers has been increasing from the pandemic lows, is now approaching pre-pandemic levels. Again, this is not the sign of a no landing, and the delinquency transition rates of these maxed out borrowers are now noticeably higher than pre-pandemic, resulting in a higher transition rates into credit card delinquencies overall, which just validates exactly what's going on at McDonald's and Walmart. You're starting to see that even wealthier consumers are getting course constrained by inflation. Their wages are not keeping pace with it. They're having to trade down. And yet you would think there would be some reaction from the Fed. Well, good luck with that. As Fed Williams see no current reason to change stance of policy. Maybe he likes shopping at Walmart. I don't know. Maybe he doesn't have to worry about it. But this just goes to show that the central elites are clueless about what's going on with the average American as monetary policy is restrictive. Well, that's obvious because you start to see effects when a debt-based economy runs out of money, and one of those is you see delinquency rates go up. Another one is when consumers start trading down and spending less, and sure enough, that's exactly what we're seeing and exactly what the Fed wanted. And they think, well, it's helping the economy get better into balance as monetary policy is in a good place. And as I would suggest, if you have a business and you have too much demand, well, you increase supply. But if you're the Federal Reserve and you're running a business, you have too much demand, well, you get rid of the demand. The problem is demand is now gone, suggesting we are on path now for a recession. It is unavoidable. And Williams welcomed the report, which he said pointed to further progress in getting inflation down to their target. He says, my own forecast is inflation will probably be in the low twos by the end of the year, maybe up to 2.5% for the year as a whole, but moving closer to 2%. Well, reality is if consumers are indeed maxed out. And that Liberty Street Economics, that was a Federal Reserve Bank report. So if indeed we are seeing consumers maxed out on credit, hitting into delinquency, what Walmart's saying, what McDonald's is saying, what all these retailers are suggesting, well, it means inflation isn't going to be 2.5%. We're going to be lucky if it's somewhere near zero. And we have further evidence the demand destruction is real as U.S. industrial production stagnates as factory output is now in decline. This is staggering because what you notice here is when consumer demand goes away, well, it hits the factory level then. And of course, that backfeeds, as you're about to see, right into the U.S. labor market. And that's in a dangerous way as manufacturing accounts for 3/4 of the total industrial production has now had difficulty building momentum. Well, it's not a surprise because consumers aren't spending. And this amid rising input prices and inconsistent demand. The ISM's latest measure of factory activity moved back into contraction. Here we see industrial production month over month at zero. Manufacturing output now in contraction. This dangerous territory because when you see industrial production start to contract, and this is shown on a year-over-year rate of change in blue, I want you to see the continued unemployment claims because it makes sense. When demand goes down and a factory doesn't have the workload to keep its employees busy, well, they get rid of them. And when they go on the unemployment line, their spending drops. They have to trade down. They use out their credit cards. And next thing you know, we're a matter of months away from staring down the abyss of recession. Here you can see industrial production against continued claims. They look like relative mirrors of each other in most cases, but you can see these downward accelerations in almost each and every time, lead to an increase in unemployment claims. And it tells us, based on this data, we're on the cusp, if not the early stages now, of heading into a massive recession. And business equipment production has dropped in 4 of the last 5 months, while output of consumer goods edged up slightly, and construction supplies demand. Separate figures Thursday show housing starts were even less than forecast, but people have less money. The Fed's report showed capacity utilization in factories, a measure of potential output being used, fell to 76.9%, while the overall industrial utilization rate was little changed at 78.4%. And when we talk about inflation, if demand at the factory level continues to shrink and the percentage of the factory that's being utilized continues to decline, it means inflation is coming down because demand is coming down. You want to see inflation? Well, you need to see your factory utilization rate break over 80%. We're seeing the trend move otherwise to the downside, which suggests now, again, we are in the early stages and now a matter of months away from an all-out recession.